Welcome everyone to Multifamily on Zoom. Happy Valentine's Day, y'all. Today, one more time, we welcome back Paul from Equity Trust, and he's gonna dive into what we already know as self-directed IRA. And this is a topic that many of us are familiar with, but there are so many people in this country who have no clue that they can use their 401k or use their IRA money. And basically, like it says, self-direct how you want it to be invested. So that is exactly today. We're gonna dive into it. We usually have Paul here twice a year to come and talk for us, and he's very gracious and so generous to come here and talk to this community and help us understand the nuances when it comes to investment a custodian um using a custodian company. If please, if you can go ahead and mute yourself, please. Thank you. So once again, let's get Paul right here. So I think I have let me I just opened it. Where did it go? Hold on. It disappeared. Okay. Yes. So let me tell you a little bit about Paul. Paul, it's another one trying to open. Sorry. Okay. Okay. I have something in here. It just covered this thing. You won't let me. Technology always doing these things to us. The PDF file is acting up. All right. So I'm gonna leave it alone because my computer is acting up. Microsoft is telling me I cannot do certain things. Why? I don't know. Yeah. Okay. All right. All right. Okay. Paul Urbis is an account executive with Equity Institutional Services, where he educates investors and businesses on preserving wealth, increasing cash flow, and deferring taxes, empowering them to take control of their financial future. Paul's diverse background spans industries including construction, education, technology, and coaching. He holds degrees in business administration and sports management from Augustana University with a minor in psychology and completed his Master's of Science in Strategic Leadership at Black Hills State University. Based in Sioux Falls, South Dakota, Paul enjoys spending time with his wife and two daughters, reading, walking his dogs, and keeping up with NFL and NBA games. All right, Paul. Welcome back. And we so appreciative of you for coming here this afternoon on Valentine's Day.
Thank you very much. Thank you, Suze. I really appreciate the opportunity and yeah, really appreciate you giving me the floor to go ahead and speak to self-directed IRAs and how we could go ahead, use those to start taking advantage of those retirement funds, the tax advantage position they're in to create that compounding wealth and financial freedom. Yeah, just very appreciative of SME Capital and you for having me on today. So without further ado, I'll go ahead here and start sharing my screen. All right, let me know, Suze, if you can see that transition. Can you see that next slide right now?
Yes, yes, we can see
Perfect.
it.
Perfect. Wonderful. Well, thanks again. Today, want to go ahead, dive into Equity Trust Company, speak a little bit about equity trust, and also equity institutional services, the division in which I belong to myself. So, fun facts about Equity Trust Company: the oldest and largest custodian of alternative assets in the world, starting out at 52 years in business, as well as now 82 billion. I know that screen says 77, now $82 billion of assets under custody. And I want to call out what that assets under custody means, because truly it means that you have a bank. And that's why I find myself here in Sioux Falls, South Dakota, is because we are incorporated through the South Dakota Division of Banking. And that's what we are on paper. When I first heard the word custodian, I thought of a groundskeeper, right? But really what a custodian is it's a bank. It's somebody who's going to go ahead and represent you. Now, we differ quite a bit from some other financial institutions. You might have seen them. We just had the Super Bowl here, last weekend, last Sunday, right? Less than a week ago. Those institutions like Charles Schwab, T. Rowe Price, J.P. Morgan, right? Morgan Stanley, you probably saw advertisements run for. And we're going to differ quite drastically from those competitors. Those institutions with those financial advisors are concerned with a different metric, that being assets under management. They want to go ahead, get you into those proprietary funds, those mutual funds, those exchange traded funds, the S&P 500, stocks and bonds, because it's where they're compensated. And it's where they make the revenue is through those assets under management, which is why they don't allow access into private equity opportunities and other alternative asset classes. It's not where they make the revenue. And that's where we came on scene, is to serve that niche, to go ahead, serve those investors who want to create wealth beyond Wall Street and get into Main Street with those retirement dollars. We do have a few different offices as well located around the country. Offices here in Sioux Falls, in Chicago, Illinois, in Fort Myers, Florida. And then that building off to that left-hand side of the screen is where we're going to be headquartered in Cleveland, Ohio. Now, a little bit more about the division I belong to, Equity Institutional Services, formerly known as Midland Trust Company. Up until August of 2023 is when we went ahead and rebranded to Equity Institutional. A few reasons leading up to that. One being our 1031 exchange line of business, where we're helping real estate investors defer capital gains taxes when they're selling and purchasing real estate. The other being to how our client service department works. We differ from quite a few custodians out there in how we respond and how we meet the needs of high net worth individuals. When working with Equity Institutional, you're going to go ahead and have a dedicated representative, which differs from a lot of other custodians out there, where you're going to get a 1-800 number, press 1, press 2, press 3. So much to the point where leading up to our acquisition in 2023, Forbes Advisor had rated Midland Trust as the best custodian to work with when it comes to these private equity investments. So syndications and real estate fall right into that niche. So what is truly a self-directed IRA? A self-directed IRA is an IRA like any other. That term self-directed is going to be that marketing term. It's going to have the same rules as any other IRA. What's going to differ is what we just covered. The role of that custodian, and can they actually get you into an alternative asset? Is it administratively feasible for them? Is it something they're specializing in? Now, when it comes to those asset classes, there's such a broad range. Most of our investors are going to be investing in private equity, whether that's a real estate syndication, a real estate fund, whether that is venture capital, but so many other ways to invest in real estate as well, through secured notes, unsecured notes, going ahead lending, becoming that banker, right? Going ahead creating that interest rate, or by going ahead purchasing real estate outright directly, whether that's single family home, multifamily, commercial real estate, industrial, and the like. Other ways people invest with their self-directed IRA: precious metals, cryptocurrency, futures, foreign exchange trading. The list goes on and on and on. I mean, I've even seen groups go ahead and do such unique strategies that I never would have thought possible until joining the industry. But the IRS does come out and say, here are the things you're not able to invest with those retirement funds. And this is something I would go ahead and write down. You're not able to invest into any antiques or collectibles. And the reason why is because the IRS cannot put a fair market valuation on it. The beauty is the eye and the beholder in a very expensive portrait, an expensive piece of jewelry, or the like. They aren't going to be able to go ahead and actually find the value when it's time to take that distribution and time to create that taxable event. So you're going to want to stay away from any antiques, any collectibles, any jewelry, anything without that fair market valuation. Outside of that, S corporation stock, due to the tax advantages it already receives, as well as anything that's going to be federally illegal. So anything like cannabis at this point until if it were to be approved at the federal level. Life insurance policies are another thing you're not able to go ahead and purchase with these retirement funds. But there is a wide world of different areas that you can invest in. Others being oil and gas, that's another one. Mineral rights, so many different asset classes. But you need a custodian to go ahead and get there. It's not an if, the IRS requires it. Now, here are some of the few reasons that people will go ahead and actually use those dollars and invest into those retirement offerings. One being the tax advantages. Retirement funds offer a very unique position in that you're not paying the capital gains taxes on those returns. So it is a very attractive dollar to invest. Diversity is also a huge reasoning that people will go ahead and start investing alternatively with their retirement funds. Most Americans and most millionaires in America hold over 70% of their wealth in their 401k or IRA. So this is where most Americans hold their investable dollars. And most of those investments are too oftenly tied to the public sector, where you're riding the same roller coaster that every other American citizen is riding as well. You're chasing those highs and you're chasing those lows with that liquid asset. You'll even see that recently investors from the Big Short, Michael, right, going ahead and even calling out and shorting $1 billion worth of AI stocks due to overvaluation. Lots of talks in the market whether or not people should go ahead, be in those public stocks, or start moving them over into hard assets that have returned year over year. When it comes to going ahead and doing this, anecdotally speaking, it's always smart not to have your eggs all in one basket. So it's a great way to go ahead, start getting into hard assets and start diversifying your portfolio. Administrative fees is another reason people will go ahead and consider this. At a lot of traditional financial institutions, they're going ahead and they're actually paying a percentage for those assets under management and fees, which can quickly add up as compared to equity institutional, where you're paying on a flat fixed fee schedule, where there's not going to be that adjusting for how much valuation you're bringing over here. Job change. I really want to highlight that on this slide. It's going to be one of the more common reasons people will go ahead and do what's known as a direct rollover to start deploying these assets into real estate. This is a huge event which allows you to go ahead and tap into that retirement capital. Most active employer 401k plans do not allow for what's known as an in-service rollover, but it's still a question worth asking. I'm going to give an example here. My active employer is Equity Institutional Services. I would have to go ahead if I wanted to roll those funds over, and I would have to give my plan administrator a call and ask if an in-service rollover is possible. Now, I want to manage expectations. Most of the time, it is not allowed, but on occasion, it will be allowed due to age, if you're over 59 and a half, and length of tenure. Still a question worth asking at the end of the day. The worst case scenario is they're going to tell you no, and you're in the same seat you were in yesterday. But if I were to leave, if I were to change employers, I would then have access to those retirement funds, and it would be bona fide. I would 100% be able to go ahead, take those in a direct rollover, push them into an IRA account where I could then invest alternatively in nature. Illiquidity is another reason that I'll see people go ahead and do this in times of uncertainty, and as well for serial investors. Say they've already invested in two, three deals that year, they might not have the cash sitting in the checking or savings account, but it's surely going to be in that former employer 401k account or IRA. It's where most of America is going to go ahead, hold those investable dollars. As we mentioned earlier, tax mitigation is huge. Being able to go ahead, avoid capital gains taxes makes this a great way to go ahead and make those investments. Another reason to go ahead and diversify, because now I'm investing in a hard asset, not having to pay that capital gains tax at that qualifying event. Now, this is a double-edged sword in that you can't write off the losses either. This is my IRA making the investment. I'm not making the investment personally, rather my retirement account is. Due to that, I'm not able to personally take advantage of that depreciation. So something I want to call out here as well. Now, what type of accounts can be used? So many different accounts can be used to be funneled into this IRA. A 457B could be used, a 403B. Now, those two plans are going to be seen with those local state officials as well as those in those public school systems. But the most common one, as we covered, is going to be that 401k. It's going to be the most common vehicle for those who work in industry, which is going to be most of us Americans, right? Now, another plan that's not on this slide, a thrift savings plan for uniformed guard members, can be used as well. A great plan that the federal government offers for those service members that is accessible as well to invest alternatively after those rollovers are performed. Even qualified annuities can be rolled over into IRA accounts as well. So lots of different options out there. Now I want to go ahead and break down some of these IRA accounts. The differences in between them. The traditional IRA, a pre-tax account in nature, it's going to start having required minimum distributions once when you get to age 73. Those qualifying events to where Uncle Sam is now tapping you on the shoulder saying, hey, you need to start taking some of these funds out. It's going to be unique to those pre-tax accounts where when I'm contributing to that IRA, I'm not paying taxes. When I'm investing with it, I'm not paying capital gains taxes on the sale. When you would see a tax from having a pre-tax vehicle like a traditional IRA is when you start taking those distributions post 59 and a half. When you take it, I want to give an example here. Let's say I pull $20,000 out of that IRA. The IRS is going to look at that as Paul receiving an extra $20,000 paycheck this year. And they're going to tack that $20,000 on to my earned income for that year. And that's going to be what I pay ordinary income taxes on. Now, when you start taking those distributions, it's important to be aware of how much earned income you already have for the year to ensure that that distributable amount is not going to push me up into a higher tax bracket where all of a sudden I'm now paying a higher percentage on all of my earned income for the year. Something important to be aware of later in life. The contribution limit for that traditional IRA is going to be $7,500, $8,600 if you're over 50. The Roth IRA, this is one of my favorite accounts because it allows you to go ahead and compound your earnings in the absence of taxation. Not many places in the world can you do that, but you can in the Roth IRA, which makes it very, very attractive when you're investing, especially in private equity offerings like a real estate syndication, where you're going to see a higher return than a typical stock bond or traditional offering. So something to consider when making investment is using post-tax dollars to do so. And the reason I mention that is because with the Roth funds, you are paying taxes on them when you put them into the account on the seed investment. But when you go ahead and pull those out post 59 and a half, you can do so tax-free, which is a very, very ideal situation to be in. The SEP IRA, that's going to stand for a Simplified Employee Pension. It's going to be limited for business owners with 25 employees or less. This is going to be attractive for some self-employed individuals, depending on if they qualify or not for the solo 401k, but we'll get into that here in a little bit. Contributions amounts for that are going to be capped at 25% of the salary or $72,000, whichever is going to be lesser of the two. A simple IRA, that's going to be a savings incentive match plan for employees. That's going to be limited for business owners with 100 employees or less. Contribution limits for that are going to be capped at 17,000 or 21,050 or older. The traditional SEP simple, they're all going to be pre-tax accounts. Another account I want to mention is an inherited IRA. And this is another piece I would go ahead and write down. If you're on great terms with your spouse, I know today's Valentine's Day, so make sure that we go ahead, buy those flowers, gentlemen, for that special someone in your life. But really important here, when you're creating IRAs, if you're on great terms with your spouse, you're going to want to go ahead and list them as your primary beneficiary. And the reason why, if you were to pass, they're able to go ahead and take that IRA and transfer it completely into theirs without any penalty. Now, let's say you listed your children as your beneficiary rather than your spouse. Now they have a special rule once when they go ahead and inherit that IRA. They have a decade window now that your spouse wouldn't have, but children do, into which that IRA account needs to be fully distributed after a 10-year timeline. So important when setting this up strategically that we're naming those children as a tertiary beneficiary, as that secondary, and our spouse is the primary. A solo 401k is going to be another type of retirement account that can be used to invest with retirement funds. But the solo 401k is going to be limited to those who are business employers who have earned income, but they have no common law employees. So the only person that they could have on payroll is a spouse. Typically see those in, think of doctors, attorneys, lawyers with very small practices. A lot of those practicing members of society are going to go ahead and qualify for one. Now, the great thing about the solo 401k is it has a contribution limit of over 70K, and you can contribute to it in a Roth position. So it is a vehicle that really allows you to go ahead and push more funds in a post-tax position than any other type of account out there. So it really helps you go ahead and just stack on the post-tax dollars, where with that Roth IRA, you're going to be capped at $7,500 if you're under 50, or $8,600 if you're over, on an annual basis, where this solo 401k really, really incentivizes those post-tax contributions. Two other accounts that also can be used that most people aren't aware of: an ESA, an education savings account. It's going to be post-tax in nature, similar to the Roth. You're able to go ahead, make those contributions of $2,000 every year. Now, I've seen people use these to invest into real estate syndications as well. Let's say you have a very intelligent child. Let's say they're a National Merit Scholar. They get a full ride scholarship, right? Or maybe they're a Rhodes Scholar, what have you. You could still use these funds to invest alternatively if you don't go ahead and use them for those qualified education expenses for your children. The other account being a health savings account. It's going to be pre-tax like the traditional, but let's say you have a healthy family, right? Let's say you contribute to this HSA. That limit's going to be $8,750. But let's say your kids aren't sick. You guys are a very active family. An apple a day keeps the doctor away. We're exercising regularly, right? We're not going in and necessarily having these medical expenses leave the account. Well, now we could go ahead, use that to invest into real estate as well. Now, some considerations to be aware of. As I mentioned earlier, the investment's being made out of the IRA. It's not being personally made. We're not able to qualify for that depreciation. But that's also the same thing that allows us not to have to pay capital gains taxes. So it is a blessing. You need the custodian, as we mentioned earlier. It's an IRS requirement. Cash flows need to involve the custodian. And we'll get into this a little bit later with the checkbook IRA. It's going to be an important part. Lead time. It's going to depend on if it's an IRA to IRA transfer or if it's a direct rollover from a former employer account like a 401k. If it's an IRA to IRA transfer, trustee to trustee, we as the receiving custodian will help you endorse a transfer form. Depending on who your custodian is, they may require a pen signature as opposed to a DocuSign, and they may require an account statement. Some don't. We would go ahead, send that over to your custodian. They would send us the funds. We would go ahead, help you endorse the subscription agreement. We'd take a verbal authorization as a security feature. We'd post your wire, you'd be invested. As compared to a direct rollover from like a former employer 401k, funds would actually be pushed to us rather than pulled. So after helping assist you with account opening, I would then go ahead and send you a PDF with those delivery instructions. Your current custodian would actually send us a physical check in the mail. We would hold on to said check for 5 business days until it clears, and then help assist you with finalizing your investment. That's why that IRA to IRA transfer done wire is going to be that 2-week timeline, 401k rollover being that 3-week timeline. As I mentioned earlier, active 401k money is typically off limits, but it's still a great idea to ask your plan administrator if an in-service rollover is feasible. We did cover those steps to go ahead and get invested. I want to briefly touch on those checkbook IRAs today as well. Now, what is a checkbook IRA? That checkbook term, just like the self-directed term, is one big marketing term. What a checkbook IRA actually is it's a manager-managed LLC whose sole member is the IRA. That's what it is. That allows that IRA owner to have full signatory power so they can write checks and close on documents to go ahead and secure that real estate. Now, a huge reason people will do this is if they're buying real estate property because of that limited liability company veil. It's going to protect you as well as your IRA. So it's a must if you're going to invest into a hard asset. Also, transaction speed is going to help as well. So bill pay, going ahead, setting it up on a long-term lease, short-term lease, Airbnb, Vrbo, what have you, it's going to make things a lot simpler in the long run. Now, this is certainly something that we can help assist with. Going ahead, creating the articles of organization, the operating agreement, registering for an EIN, filing in the state, as well as setting up the bank account. But we don't need to. This is something, if you're a real estate professional, if you have a lot of experience in setting up LLCs, or if you can save money with a buddy who is an attorney who can go ahead and catch a deal for creating one, by all means, you could go ahead and create the LLC. You do not need to use our LLC services. It is something we provide for convenience. And here is what that structure is actually going to look like. I'm a visual learner, so I think this is just a great piece of literature for people to go ahead and actually take a look at. We would help assist you move retirement funds from that other custodian who's not able to help you alternatively, move them into that IRA or 401k, set up that LLC. Now, the movement of funds here is really important, and it needs to be followed meticulously. Once when funds are in that LLC account, they're to be used for real estate investing and real estate investing only. You're not able to go ahead and pay yourself a fee from that account for managing the property. Although you can manage the property, you can get the lease, you can get the tenants, you're not able to give yourself that manager fee. When that expenses and income come from those investments in and out of the LLC, it's terrific. But when you want to start personally taking that money, say you want to take your grandkids to Disneyland or go buy that new Chevy Silverado 3500, what have you, you're going to want to send a wire from that LLC bank account back to us as your custodian and take the distribution directly from your IRA account, because it will need to be reported to the IRS as a distribution. The same is true of contributions. If you want to add money into that account, you'll want to go ahead, move funds from your personal checking account to your IRA here, and then have us do the transfer from your IRA into that LLC bank account for you to invest. That ensures a segregation of your funds, that everything is kept above board, and that at the end of the day, you won't have any turmoil when you go ahead and start investing. Now, some further considerations. I want to speak to disqualified parties today, and this is a really big part of IRA investing. The IRS comes out right away and immediately tells you parties that you're not able to transact with. The first party is going to be myself. That's why I'm not able to give myself that manager fee, because I'm prohibited to my own IRA. Not only am I prohibited to my IRA's investment, so is my wife. My spouse is off the table too. Any of my direct ancestors, so my parents, my grandparents, any of my direct descendants, so my kids, their marriages, my son and daughter-in-laws, their offspring, my grandkids, great-grandkids, their forth. They're not able to go ahead and personally benefit from my IRA's investment. Now, what does that mean, layman's terms? They can't swim at the pool that is owned at the property I own with my IRA. and they can't, but I also can't. I can't personally use the property. I I and those parties also can't perform sweat equity at the property. I'm not supposed to be the one up on the roof reshingling it after a storm or replacing the AC unit or water heater myself. I'm supposed to contract that out to a third party that's not one of those disqualified persons that we just covered. It ensures that there's arm's length to the transaction, and that's really what the IRS is after. Now, the individual responsibility here, if you were to move forward with the checkbook IRA that has the LLC component, you're now managing an LLC. So very similar to, I'm sure, your other real estate investments where you have other LLCs helping protect you personally. The difference here, while we're going ahead waiting to receive funds either via transfer or rollover, we're also at that point either helping you create and stand up the LLC or you're doing it with your attorney. I want to make sure to take some time today here, help open it up to a Q&A session. Want to help be a reliable resource for you guys, help solve some questions you might have today. Thank you all for your attention. And thank you, Suze, of course.
Well, thank you so much. That was such a great presentation, and I like how you make it appear so simple that anybody can understand it, and you break things down in a way to benefit everyone. Thank you for that. So I have some questions, and if you guys have some questions, go ahead and write them down in the chat, okay? This is one question. What are the first steps someone should take if they want to use their 401k or IRA to invest in real estate?
Yeah. I think one of the first steps is first identifying that investment. I think that's the very first thing is where am I going to put these funds and who am I going to put these funds with? I think that is really 1A, going ahead, doing that due diligence, whether it's on a property or on an investment group, aligning there, understanding where you want them placed, and then it's given me a call, either a phone call on a Teams meeting like this, interweb, via the camera, what have you, having a goals-based conversation, trying to understand what you're really after, what you're really trying to accomplish, and then trying to assess which of these accounts is going to be a good fit for those retirement funds you currently have.
So the first step is not calling you. It's not calling you. Like, let's say I cannot go ahead and open and trying to get the custodian, get my money there with the custodian company first. And then after I do that, I'm kind of like going around and trying to see what's the deal, which deal I can put my money. Can I do that?
You could, if you wanted, if you know for sure that you're going to make a private equity investment or you want to invest in real estate, you could totally go ahead, get the account created first, get everything set up on our platform. And that would really be the first part, having a conversation, having that goals-based conversation so that I can best understand what you're trying to accomplish and achieve. And then determining your eligibility. Do you qualify for that solo 401k? Is an IRA going to be a fit for you? Well, if it's an IRA, is it going to be pre or post tax? Trying to identify where you are in life, right? And when you're looking to retire, and what investment you're looking to go ahead and get placed into, because it differs. For the checkbook IRA, for example, you only need that if your portfolio is going to include real estate property. So if I'm an investor and I want to invest, let's say, in both a fund and I also want to buy a single family home, I want to do both. Let's say I got $2 million in my IRA, I want to do both. I would want a checkbook IRA for that because my portfolio includes the real estate property. But if I'm just looking to go ahead and invest in a fund, I can do it directly out of the self-directed IRA. I don't need the LLC at that point. So just trying to understand what the vision is, I think will really determine how we get there.
That's it. All right. Let's get to the next question. It's kind of like a complex question. What are the biggest mistake or prohibited transaction investors must avoid when using a self-directed IRA?
Really good question. One of the biggest mistakes is in either doing personal dealing where they're doing self-dealing. For instance, let's say I purchased acreage I own for myself. Let's say I own it, it's in my personal name, I own 2 acres, I sell it to my IRA. Huge red flag. I'm doing self-dealing at that point. The IRS is going to view it as an early distribution. So certainly something to stay away from. Transacting with any property that you already personally own, that you already, and even if it's owned in an LLC, right? Even if it's separate and distinct from you, the IRS is going to look at intent at the end of the day, and they're going to see through any veil. They're going to dig through it. So it's really important when we're doing this transaction, it's arm's length. Now, what parties can I transact with that are still my family? Well, you could still do deals with your brother and sister, with your uncle and aunt, with your niece and nephew, with your cousin, because the IRS doesn't think they're going to do you any favors. They're not going to cut you any deals. But important, once again, to stay away from myself, my spouse, my grandparents and parents, my children, my son and daughter-in-laws, and then my grandkids, thereforth.
Right. Thank you. Again, if you guys have some question, go ahead and drop them in the chat. I cannot, let me open the chat now. Go ahead and add them there, and I don't think, and then also your contact information, your name, and what you're looking for. Those are the things you might need to put in there in case somebody need to contact you. Um, so as far as taxes, I would like to stretch that a little bit more. What tax advantage come with using both a Roth IRA or traditional IRA for real estate investment?
Yeah. So there's quite a few tax advantages. And if we're going to talk about both the traditional and Roth, what I really want to talk about then is a discounted Roth conversion. So this is a strategy that's used by investors, and it can be used in a myriad in many different situations. But what a person could do is they could do that in-kind conversion. Most people think of Roth conversions as cash, and this has been around since 2010, since people could do this. The Roth IRA, it has an income limit if you're filing jointly or even if you're single. So a lot of high earners, they're not able to contribute directly into that Roth IRA. So what they've been doing since 2010 is they have been putting funds in traditional IRAs and legally doing a Roth conversion, intentionally creating a taxable event to push it over into that post-tax position where once when I start taking distributions out, they're not taxed. The earnings aren't taxed either. So it is very compounding. But what most people have never learned is that you can do this with a hard asset. So I could take an investment of $100,000, let's say for a hypothetical example, make an investment either in a single family home, into a private equity syndication offering, what have you, either or. Now I own $100,000 of shares and $100,000, let's say, of a single family home of a hard asset, right? Let's say, for instance, a bear market happens. Worst case scenario, the sky is falling. Let's say those valuations go down. I've already made the investment. The funds have already left my account. They've already been wired. I have the securities now. Let's say that property is worth 80 grand, or those shares devalue to 80,000. What I can do now is I can intentionally create a taxable event. I could do a Roth conversion. I can take these pre-tax traditional IRA holdings. Let's use this example of two $80,000 investments. Pay ordinary income taxes on 160,000 of those. So creating an initial taxable event. Now you don't need to do you could do a bite of the elephant at a time. You don't need to do 100% of the offering like I'm doing in this example. And you could move them to a Roth position. So now those holdings, the single family home and that real estate syndication holding, are now in a post-tax position. So now when they experience growth, when the market rebounds, when it picks back up, well, now those, let's say the holdings at 130,000. Let's say that's what the shares are worth. That's what the house is worth, right? Well, holy moly. Now I've just paid $80,000 on that, on ordinary income taxes, but I pushed it into a post-tax vehicle while the asset's still in kind. So it's an awesome strategy that's used. It's used in many different asset classes. It's used in real estate. It's also used with mineral rights as well. those are two of some of the more common asset classes. I'll see those in-kind Roth conversions occur. That being said, the great thing about investing with retirement funds, you're not paying capital gains taxes on your returns. An important part of this game, though, is to figure out how do we not pay income taxes on our distributions as well.
She has a question for you. She wrote, if you invest with a self-directed
Mm,
IRA into an RV resort park syndication, can you stay at that RV resort? Do
yeah,
you need to pay full price for the rent to stay there?
good question. You are not supposed to stay at that RV park, so you're not supposed to personally benefit from it. Um, truly. So if you are going ahead and using IRA dollars, you should not be staying at said RV park, even if you're paying fair market value, because it could be construed as you benefiting from your IRA's investment. You put a piece in the pie. Now the RV park's doing better. I have nicer amenities now. It's so safe. It's a nice RV park. It's all taken care of. It all looks very nice, no issues, and I'm benefiting from that because of that seed capital I put into the fund.
All right, but you can stay in the RV park across the street
You
and in
can.
order for you to visit.
That's right. That's right. You can keep an eye on things as a limited partner. You got to share the equity. You're just right across the street. Know exactly what's going on. That's right. That's exactly right. Good point, Suze.
That is too funny. Okay. Wow, this is real things. I would have never of that. Would have never thought of that. That is so interesting to say the least. I think you guys don't have any more questions. I have questions. I'm gonna go with my questions. So, what was my question? So, can you share? I think that may be the last question because I don't know how long this may be because we only have 10 minutes left. Can you share a real life example of someone who successfully accelerated their retirement account using real estate? Do
Yeah,
you have examples? I'm sure you have tons of them. Would you
yeah,
mind sharing one of those?
I've seen people do it with many different asset class groups. I've seen people do it with raw land, where they will literally just purchase grass out in a farm field here not too far away from us in Sioux Falls, South Dakota, and they'll hold on to it for years, let it appreciate. Their only expense is the actual property tax for it, and they're just allowing it to go ahead and accumulate value as our city continues to grow and develop around that farmland. I've seen it used in multifamily syndications where people are going ahead and getting a very large equity multiplier for going ahead and making that seed capital investment. I've seen it used in private equity, venture capital, where people are going ahead and investing into different portfolio companies owned by much larger entities that are going ahead, throwing their successful individuals into different boards, helping run these enterprises, creating value for different investors. Um, Seen it used in the medical industry with real estate as well. Um, think of like office space for like dentists, doctors, and the like. Um, I think sometimes I have a harder time of thinking what asset class hasn't it been used in real estate yet. I've seen self-storage investors make money. I've seen groups. Here's one for you. I've seen groups purchase buy a self-storage facility in Kentucky, purchase bourbon, hold it in Kentucky so it's still classified as bourbon. If as soon as if it were to leave state lines in Kentucky, it would become whiskey. Hold on to it though, calling it bourbon because it's in the state lines, and then sell it off as a portfolio. So there's just so many different ways when it comes to real estate to make money with these retirement funds.
Okay. For someone in their 30s, 40s, or 50s, how
Young
should their
people.
strategy differ when using retirement fund for alternative investment? I don't know if it's within your lane, this
Yeah,
question, but yeah,
yeah.
you can
Put
share something?
put as much money into the post-tax position as you can right now because those 30 to 50-year-olds, they're young I mean, you might be 50 not thinking you're young, but you are. Like the average life expectancy is well into the late 70s, right? I mean, if you're in that 30 to 50 range and your belief is that one day you're going to be in a higher tax bracket, that you're going to be earning more later on, then it makes complete sense to start considering doing Roth conversions, to start pushing all of my retirement funds into a post-tax status. Because later in life, once when I'm 62, 64, 65, and I'm thinking of, and I'm getting close to really pulling those out, or really once when I turn 59 and a half, right? That's the age of distribution. That's the age I can empty out that Roth, penalty free, tax free. At 60, am I going to be making more than I am at 30? I sure hope so. If I'm not, I'm going to be very disappointed in myself. I will be. I'll be very disappointed if I'm not earning more at 60. So I want to create that taxable event early here in life when I have lower income. I want to pay those taxes now. I want to bite the bullet. I want to pay the piper because later in life, I'm going to be earning more. I want to be able to take those out without paying ordinary income taxes. And here's another thought. I've never heard of federal taxes going down over decades of time. They're only going to increase. Those, it's sad to say, but those rings are only going to go up and up, and those percentages are only going to continue to get higher. So I'm going to pay my taxes now, here in 2026, before I have to pay them in 2056.
Yeah, I agree because, and you have to think about inflation as well. So inflation, that's another way you're trying to beat inflation.
Mhm.
That's one of the best tool in order for you to offset inflation. All right, go ahead, Bob. Bob has his hand raised. You muted.
Thank you. I'm just going to give a convenient example. I have both I have a self-directed Roth IRA with equity trust, which I used back in my single-family real estate days, and we I had it funded, bought property, and as a departure from our typical investments, this was a property that we ended up a, uh, a wholesaling type arrangement where we put money in it and develop it partly and then resold it to another developer there. And yeah, we took funds from the account to the refurbishment that we did along the way. Then the capital gains transaction, all of it was untaxable and back into the Roth account there. So it was a very useful tool for that. That's just an example that you were asking.
Yeah,
That's
that is
all.
great. That is great. Thank you for your testimony, Bob. And I
Certainly.
was also watching, I was telling Paul earlier on Facebook, I think I saw someone at Equity Trust, mostly in engagement um director. He was talking about a real case study where he even brought the people's name that these people came in 2011, and right now those people are getting $200,000 every year on their investment, you know. So these are the real life example that actually occurs when you go that route. And it's so possible, like Paul was saying, if you live in a job, most likely that money you cannot live it with the job. Back in the day, company will leave it, you'll be there for a while, but now you have to move your money right away. So it's a way for you to redirect that money into a place where it's actually going to make you money faster. And as we call it, trying to accelerate that, you know, that fund. And well, we at top of the hour right here, 2:56. Paul, we have one more question for you. If someone takes only one action after today's session, what should that be?
Mm. If someone were to take one action, man, one, that's such a good question, Suze. I would have them go check their returns in the public markets. Go look. Go take a look. Go take a peek. what your current portfolio looks like, because so many Americans have no idea. So many Americans go through life having three former employer 401ks at three different custodians, all aggregated into different accounts that are just out in the abyss. So take a look some time to go ahead, check in on those retirement portfolios. I know they're supposed to be long hold strategies, but it doesn't hurt to go ahead and check in on your assets. And if you're interested in going ahead investing alternatively, go ahead, reach out, give me a call. I went ahead, put my number, email information in the chat. Would love the opportunity to go ahead, help answer questions, and be a reliable resource for people, help understand their goals and give them their options.
All right, guys, go ahead and take Paul's number right now. And I will suggest that you guys write those things down because I know a lot of time after that you guys call me, Sus, what was the name of that guy? Do you have his number? So let's get into the habit of writing those numbers. That way, because you may be looking for me and I'm not available. And that way you can go ahead and call him right away or email him. I will always be there, be a resource if you need me. But there have been times you want to do something really quick and you had it on your to-do list and then you're trying to reach Suze and Suze is not available. So now you have to wait until I'm available. So go ahead and get this and you can reach out to him and have that conversation with him. So if y'all want, we want to take a picture. If you want to open your camera, if it's okay, open your camera. Let's have a picture. I would like to see everybody in here. There's not only four of us in this meeting. If possible, we take a picture. What I do with these pictures, I put takeaways on LinkedIn. I posted them. And that way other people know what we do here. And I know you take time from your busy Valentine's Day of all days to be here. So we may as well try to make the best out of it. So I appreciate it for you to be here, all of you to be here today. All right. Oops. So hold on. I think somebody say I need to disable his hold on. The thing is I don't even see you, Sean. Okay. All right. Okay, all right. There you go. Sean, you up. Yay! Sorry. Okay, so let's take a picture. Hold on. I'm not a great photographer. Let me get my stuff together. Hold on. Let me pull this thing. And okay, I think that's the one from last week. I'm so okay. Let's go. Ready, set, go, cheese. All right. This is a great picture. I like this one. We're not taking another one. Well, thank you so much, guys. It's 3 o'clock. I truly, truly appreciate you guys being here. I get to see Paul next week at BEC, Best Ever Conference. I'm excited about that. As I told you guys, next week we're not gonna have a meeting, and the reason being is because I'm going to our newest acquisition, and over there, the internet's a little bit sometimes not great, and I don't want to have to invite somebody and the person is here, you know, uh coming here available for us and asking you guys for the respect I have for you and for my guest speakers. I don't want to meet you guys and then we cannot actually have a meeting. So I thought it was the best. We take out the stress. We don't have to worry about it. But let's meet again in 2 weeks. And we're gonna have somebody coming here to talk to us. Um, and let's see each other again. And thank you so much, Paul. I'll see you in a couple days, 4 days.
Safe travels. Safe travels, Suze.
Yeah. So I'll see you guys in 2 weeks. Bye.
See you
Have a
soon.
great one, everyone. Thank you so much.
Bye-bye.
Happy
See
Valentine's Day
everyone.
again. Happy Valentine's Day.
Happy Valentine's.